Hey, good morning, John.
Okay. Good morning.
How we doing?
Not too bad. How are you doing?
Good, good. You want to skip the next class like we did Monday, John?
Yeah, I was going to suggest that too. So we won't do the 10:30. Okay.
Okay, we won't do the 10:30, and I'll make sure I put up the appropriate video for everybody to see. Okay.
Yeah, because I'm actually in Santa Maria today, so I'm not going to be there at the 10:30. So good.
Okay, that sounds good. All right. Hi, Joshua. How you doing? Joshua is muted. You're muted.
All right. Good morning. Good morning. Good morning, John.
Oh, I liked it better when you were muted. No, I'm only
Right?
kidding.
Yeah.
Good morning. Okay. Hey, I think we have an interesting topic today on dividends and the stock market. Okay. So let's see if I can get us shared up here. And Joshua, you see the screen? Okay, here we go.
Yeah.
We are going to, let me just. Okay, here we go. Chapter is on stockholders' equity and dividends. Chapter 10, we did lessons on raising money by borrowing. Here in this chapter here, we're going to talk about raising money through a stock issue, okay? And we have various learning objectives we'll get to. Characteristics of a corporation, huh? I think we know most of this already. We can have non-profit corporations and publicly held, privately held, for-profit corporations. I'll say this, in Santa Barbara area, if you guys are looking for a job in accounting, there are plenty of nonprofits in the Santa Barbara area, and they pay reasonably well, and that may be a nice career path for some people. Nonprofits like the Salvation Army, Red Cross, American Cancer Society, the Santa Barbara neighborhood clinics in town here where I used to work. And then you have the privately held, your Facebook, IBM, like they're showing you here, Ford, General Motors. And there are certain advantages between proprietorships and partnerships. Corporations have a separate legal existence. So you can look through this slide here, limited liability of stockholders. As you know, with a proprietorship, if you go out of business, you're responsible for all of the debt, even beyond what your original investment was. That's not true with a corporation. You own a corporation, you own stock. So if you own $100,000 worth of stock in IBM and IBM went out of business, you'd only be stuck for the $100,000, no more beyond that. And it's easy to transfer ownership with a corporation. You just call up your stockbroker and have them do it, or you just hit a button on your computer to do it. So corporations has some pretty good advantages. Disadvantages, there are additional taxes. You have to pay, the full 30% load. Corporate disadvantages, corporation management. I don't know why that's a disadvantage, corporation management, but I guess what they're saying is corporation is big and you have to do a lot of analysis and working to get that done right. Government regulations, yeah. Here's a favorite thing to look at, huh? A corporation org chart, huh? Just remember that the stockholders are the owners of the company. I own some Coca-Cola stock and I'm allowed to vote. If you go out on the shore here at Ledbetter Beach and you pick up 1 grain of sand, that's how much I own in Coca-Cola's percentage. But the point is, as a stockholder, I vote to hire the chairman and the board of directors. And the board of directors will choose the president and the officers, okay? It's the board of directors who get the account, who assign the accountant for the year-end audits as well. So you get the stockholders who make up the board of directors who hire the officers, okay? Just a quick look there. Limited partnerships, S corps. I know very little about those, to be honest with you. And we are not going to really take a look at that. It's not going to be on your test. And we have courses beyond this that will talk about those. Forming a corporation, you file an application, you get a charter, you come up with your bylaws, you know, the rules for this business, and they generally incorporate in a state whose laws are favorable to the corporate form of business, and corporations engaged in interstate commerce must get a license from each state. Hey, John, Joshua, do either of you know what state is very popular for corporations to file?
Delaware, right?
Delaware. You are correct, sir. Delaware, because Delaware has, for some reason, decided that they're going to make it easy for corporations to register. I guess they have lower fees and less onerous rules to do that. Did you know that, Josh? Delaware? That's a little bit of trivia. Stockholders' rights. You own stock, big deal. What does that do for you? Well, if you have common stock, you can vote in the election of the board of directors and on actions that require stockholder approval. Share the corporate earnings through dividends, hopefully not guaranteed. Stockholder rights, keep the same percentage ownership when new shares are issued. Your preemptive right. Before you had 14%, new shares issued, you still have 14%. Stockholder rights, share in assets upon liquidation. Well, this is not a very happy thing, but if the place goes out of business, you as a stockholder are a little bit low on the totem pole. You don't get paid until the lenders and creditors get paid, and then the stockholders will get paid. And there's an old-fashioned stock certificate. Where I used to work at Thomas and Betts, every year, my level of management, we got a little bonus. We got maybe 50 shares of stock. And in those days, we actually got the paper. It came in the mail where my boss would hand it to me, and you'd get this exact certificate here. Nowadays, everything is on computer, and you can get one of these only if you request it. But this is the Franklin Life Insurance Company, $100. And I'm trying to see if this is a preferred stock. It doesn't say. Okay. Stock issue considerations. Authorized stock. We're going to talk about three categories of stock. Authorized stock. This is the amount at max that a company can offer to the world. Authorized stock. The number of shares you're allowed to sell. So you set up your corporation, and maybe the state said, okay, you can issue 1 million shares to the world. That's your authorized number. And the number of authorized shares is often reported in the stockholder section. You'll actually see authorized, issued, and outstanding. So the first of a few terms you need to understand clearly is the authorized stock. Stock issues. Stock is issued now. Corporation can issue common stock directly to investor or through a banking firm. We don't really care about that. Par and no par value stock. Par value is a meaningless number. It is an arbitrary required number for most states. If you have a stock with a par value of $1, it does not mean that the stock is only worth $1. It's just that you chose $1 as the par value to meet a government requirement. You have a stock for $1, like Facebook. Facebook went public about 10 years ago, and the par value was $1, I believe. Well, they didn't get $1 when they put it out for the public. They got like $40 a share. So the par value has nothing to do with the value of the stock. It's just a legal requirement, okay? Which of the following statement is false? False. Legal capital is intended. So let's look at the ones that are true. Ownership of common stock, you get a voting right. Stockholders' equity section is going to begin with the paid-in capital. which is akin to the owner's investment when we're doing proprietorships. And the authorization of capital stock does not require an accounting entry. Indicate whether the following statements are true or false. Similar to stockholders have unlimited liability. That is not true. Relatively easy for a corporation to obtain capital through stock. Absolutely. And the next three are false. The separation of ownership and management is an advantage. That's a bunch of baloney. The journal entry to record the authorization, we'll go past that. I don't like looking at the questions when they give you the false answer. I'm kind of a glass half filled kind of guy, you know. We're back to this, or I'm not sure if we saw this yet. Corporate capital, huh? We have something called paid-in capital. Paid-in capital. That's the common stock that we issued to the world and the preferred stock we issued to the world. So we issue $1 common stock and maybe we got $10. That means that $9 is going to show up in an account called paid-in capital in excess of par, okay? Our entry is going to be a debit for $10. That's what the public gave us. The par value is $1. That'll be a credit to common stock. The $9 is a credit to paid-in capital, which is also an equity account. You have the same thought process with preferred stock, and eventually retained earnings becomes part of your equity section. Paid-in capital, the total amount of cash paid by stockholders in exchange for capital stock. And now they're talking about retained earnings. Retained earnings is net income that a corporation retains for future use. Here they're just showing you the closing entry, it looks like. We close out retained earnings to, close out the income to retained earnings, closing entry, okay? If Delta Robotics has a balance of 800 in common stock and 130 in retained earnings, this is how it's going to look. You're going to see stockholders' equity, and you're going to see common stock, and then retained earnings. And then retained earnings equals 930. This book is different than the Wiley book and different than what I've seen in the real world, in that normally you don't put the dividends on there. Capital comparison, proprietorship, owner's capital, common stock, retained earnings. They all have a normal credit balance. Keep that in mind. At the end of the first year, Doral has $750 in common net income. Prepare the closing entry. Well, there's our closing entry. We end up debiting that income summary account and credit retained earnings. So the retained earnings gets added to the common stock to get our total stockholders' equity. Now let's have a little fun. The issuance of common, preferred, and treasury stock. Accounting for common stock. Hydro Slide issues 1,000 shares of $1 par value. Well, if they issued for $1, it's very simple. You debit cash and you credit common stock. That's very unlikely going to happen. You're going to get the exact par value. But more typically, they issued 1,000 shares of $1 par value stock for $5. The market valued the stock at $5. So they received cash, a debit of $5,000 and a credit to common stock for the par value, and the balance is called paid-in capital in excess of par. Let me make another point about the par value. The only thing you do with the par value in terms of your financial statements is you multiply it by the outstanding shares, and that's your common stock number, okay? All you're going to do with the par value is multiply it by the outstanding shares to get the common stock line. And here they're showing you how it looks in the financial statements. You got common stock, and they're showing paid-in capital in excess of par. Okay, total paid in capital is 6,000, but they had a nice profit of 27,000. Hydro Slide issues $5. And the company that we have here. Hydro Slide issues $5, no par value stock, stated value of $1. And the company issues 5,000 shares at $8. This slide is absolutely 100% wrong. Wrong. Gonna have to correct that one, guys. Sorry. Here they issue no par stock, but there's no stated value. So the question on the test might be, what's the journal entry if you issue stock with no par value? And this is it right here. You debit cash and you credit common stock. There's no paid in capital in excess of par. You don't have any par. Preferred stockholders have certain advantages. They get first crack at dividends, okay? If the company went out of business and was liquidating, the preferred people would get paid before the common people, and they generally don't have voting rights. Common stock can vote for the board of directors. Common stock can vote for the auditors and different issues. Preferred stock don't. Preferred stock is handled pretty much the same way as common stock. They issued 10,000 shares of $10 par value, excuse me, for $12 a share. 10,000 times 12, guess what? That's $120,000 debit to cash. And we said that the only thing you do with the common stock line or the preferred stock line is to take the outstanding shares, multiply it by the par value, which in this case is $10, and you have preferred stock of 100, and the difference of 20,000 is called paid in value in excess of par. And just like common stock, preferred stock may have a par value or no par value. Actually, I don't know how it could not have a par value, but we'll get into that maybe. So Cayman begins operations. They issue 100,000 shares of $1 par value. We should know now that we're going to take that par value of $1 and extrapolate it by 100,000, and we're going to have a credit to common stock for 100,000. Cash, we got $12 a share, and so 1,100,000 is the paid in capital in excess of par. Here they issued, let's see what they did here. They issued 1,500 shares of $10 par value for $30. So that's $45,000 in cash. Again, 1,500 shares times 10 is going to be your preferred stock line, and the capital in excess of par is the 30,000, okay? And they're showing this now, and they're adding one other thing. We're going to get into something called treasury stock. Treasury stock, okay? Have you ever heard of treasury stock, Joshua? Okay, this is pretty interesting stuff, I think. Companies buy back their own stock. It's called treasury stock, and there's certain rules involved. Treasury stock is the company's own stock that the company has reacquired from shareholders. They issued the stock 20 years ago, maybe. And that stock has been trading from people to people in what's called the secondary market. The secondary market meaning you and me. Now the company wants to buy back 100,000 shares. Such stock is called treasury stock. And they will typically buy it for different reasons. To reissue the shares to the officers for bonuses, to pump up the stock's market value perhaps, to have additional shares available for other uses, and to increase earnings per share. Your earnings per share will be higher because there are fewer outstanding shares. I mentioned Coca-Cola. That's one of my investments, right? I own some Coca-Cola. They bought back shares like crazy, but they did it for what I think is a bad reason. They did it to have shares available to the officers and employees. So that cash went out the door directly to the big shots of the company. Did very little for the average investor. About 6 years ago, when Trump was in office, one of the first things he did was get Congress to pass a gigantic tax decrease, a tax cut, and that was supposed to stimulate the economy. Well, these corporations who got the tax cut, they didn't do what they were supposed to do with it, which was grow jobs. They used it to buy their own stock back. So treasury stock, and we're going to use the cost method. So take a peek here. Here, we bought back some shares. We bought back 4,000 shares of our stock, and the market price was $8, so that's 32,000. So we debit treasury stock and we credit cash. Let's understand what treasury stock is. It is a contra equity account, contra equity. And when we bought this stock, the value of our business fell. So you guys might be saying to yourself, how could our equity fall if we just went out and bought some stock? Well, the reason for that is it's our own stock. We can't buy our own stock and then show it on the balance sheet as if it was an asset. That would be a tremendous conflict of interest and would open up the gates to all kinds of fraud. It's pretty obvious you shouldn't be able to do it. So when you buy treasury stock, you are debiting an equity account called treasury stock, and the equity in the company has decreased. So there's your journal entry to record the purchase of the stock. Not too bad, debit treasury stock, credit cash. And now they're just showing you how it looks on the balance sheet. Look how big this balance sheet got with this chapter. We have the common stock, 100,000 times 5, retained earnings, and now the treasury stock comes on the bottom as a minus, okay? So on the test, remember, treasury stock is a contra equity account. Treasury stock may be purchased for different reasons, like we said, for bonuses for employees, letting the market know the price is the stock is underpriced, and to have the shares sitting for future uses. I love it when any stock buys back their shares and then just holds them. That's an indication that they think their stock is undervalued. So Coca-Cola goes out and they buy back their stock at $40 a share, saying we think the stock is worth more than this. And just like the public, when the stock goes up, then the corporation can sell this treasury stock back to the public. Issuance of stock, we just saw this, debit treasury stock, credit cash. Let's talk a little bit about cash dividends, stock dividends, and stock splits, huh? Cash dividends, stock dividends, and stock splits. Dividends are a distribution of cash or stock to the stockholders on a pro rata basis. In other words, if they're giving out a dividend of $100 a share, everybody gets $100 a share. It's pro rata like that. And typically you give out cash, but you can, give out stock or property, whatever. We're talking cash in this book here. Cash dividend requirements. Companies can't give out a dividend if they don't have sufficient retained earnings or adequate cash. They can't borrow, you're not supposed to borrow money in order to pay dividends. And there's a declaration. Now, here's something important. 3 dates we have to have in our mind and understand. It's dividend time. The board of directors is sitting in their meeting and they come out and they announce that they're giving out a dividend of $1 per share. Once they make that announcement, they have created a liability. Dividends are not a right. Dividends never are required of a company, even preferred stock. So when they announce that they're going to give a dividend, that's the declaration date, and it creates a journal entry. A journal entry where we're going to record a liability, dividends payable, and the debit will go to retained earnings, okay? Then there's the record date. Let's assume the declaration date was August 1st. The record date is August 15th. What that means is whoever owned the stock on August 15 gets the dividend. If you bought the stock on August 14 and sold it on August 16, you get that dividend. And there are investors who do jump in and out just to grab the dividend. That's not a foolproof safe method of investing necessarily, because the stock price can change rather quickly, but you grab the dividend. So that's our second date, August 15. And now simply the payment date is when we write the checks, payment date. And that requires a journal entry. Okay, we're going to credit cash and get that out there, okay? And debit the liability, dividends payable. Let's take a peek here. On December 1st, the directors declared a $0.50 dividend on 100,000 shares. So they're debiting cash dividends. If we were using the McGraw-Hill book, it wouldn't say cash dividends, it would say retained earnings, because this money comes out of retained earnings. So we're going to debit retained earnings dash cash dividends, dividends payable. That is the declaration date, December 1st. No entry date of, see, here's another mistake in these wily things. This should say date of record, the date of record. This is a mistake right here. That should say date of record. And it's on that date that there is no entry, just determining who gets the money. And then when you finally pay it, dividends payable gets debited, credit cash. Cash dividends, there are journal entries needed on 2 of the 3 dates, declaration date, payment date. So you have 3 dates to worry about. The declaration date, journal entry, record date, no journal entry, no activity, and then the payment date. You do need an entry. Dividend preference, right to receive dividends before commons. Now it looks like we're talking about preferred stock, huh? Per share dividend amount is stated as a percentage. See, here's another slide that's poorly put together. Where it says dividend preferences, they should say preferred stock, because now we're talking preferred stock. So preferred stock dividend preferences. The right to receive dividends before common holders. If a company announces they're going to give $1 million worth of dividends and the preferred get 900,000 of that, only 100,000 goes to the common guys. Per share dividend amount is stated as a percentage. A preferred stock is almost like a bond. It comes with a par value and there'll be a percentage, and that percentage will calculate the annual dividend. It doesn't mean you're going to get that dividend. It just means that when they pay that dividend, that's what you're going to receive. Now, preferred stocks, since they're kind of like a bond, they have what's called sometimes, most of the time, but not always, a cumulative feature. Preferred stockholders must be paid current year dividends plus any prior year dividends before the common people get anything. And we're going to talk about that a little bit, demonstrate that. Scientific Leasing has 5,000 shares of 7%, $100 par value. You see that? Preferred shares have a par value, just like common stock, but you're going to multiply that by the percentage. So this is $7 a share in dividends. So what we have here is a company that is giving out $35,000 this year in dividends, but the dividends are 2 years in arrears. In arrears means they haven't paid dividends for those 2 years. So in this particular year, when they're finally catching up, they have to pay 3 years, okay? That's the cumulative feature of a preferred stock. Now, there are non-cumulative preferred stocks where you're just screwed out of that money. I'm not sure why anybody would buy a non-cumulative preferred stock. unless they're getting a higher interest rate. And also they feel very comfortable that they're not going to miss a dividend payment.
I have a question.
Yeah.
So for the preferred stock, say the cumulative preferred stock, I buy it today, but they haven't paid any dividends for the past 2 years, how you said, am I still kind of like grandfathered into those past 2 years?
Exactly. That's exactly what we're saying with the cumulative stock. Yeah.
Okay.
You'll get paid for all 3 years. At your age, though, Joshua, you probably aren't interested in preferred stock. It's kind of a stodgy, conservative investment for old goats like me. That's just my opinion. You want to look at the common stock. That's where the growth is. But anyway, I editorialized a little bit. Sorry about that. Cumulative dividend, huh? Let's take a peek. Here's what we're talking about, Josh. You bet Corp, 10,000 shares, 8%. So that's $8 a share, right? Par value, no dividends were declared. They want to pay $375,000 worth of dividends, right? So let's make sure we read it. No dividends were declared in 20 or 21. You're going to get paid for that, right? Because it's cumulative. So we have 3 years of dividends to be paid. So that's 8% times $100 par value, $8 times 10 is 80, right? 80,000. 80,000 times 3, 80,000 times 3 is 240, right? How much do they have in total to pay? 375. We subtract the 240, and that shows that there's now 135,000 left over for the common people. Okay. Preferred stock dividends. If the stock is non-cumulative, Josh and John, if the stock is non-cumulative, they ignore the prior years. You're never going to get that money, okay? They're only going to pay you for the current year. Most preferred stocks, as I know it, are cumulative. That's the whole point in buying a preferred stock. You assure yourself a steady income. Preferred stock is non-cumulative, okay. They have 2,000 shares outstanding. The company declared a $60,000 cash dividend, determined what they're going to pay to the preferred and common. If it's non-cumulative, they're just going to get their $12,000. They're $6 per share, and the balance goes to the common stock people. Okay. Here, it's cumulative. So they're going to get 3 times 12,000. Why do companies give out stock dividends? Well, it's a way to keep the stockholders happy without spending cash. It increases the marketability of the corporation stock. Emphasize a portion of stockholders' equity has been permanently reinvested in business. Okay. One thing they're not going into at all that I do want to talk about is a stock dividend, Josh, is you own 100 shares today at $100 per share, right? They issue a 100% stock dividend. You now own 200 shares. Isn't that great? But they're only at $50 now. You own twice as many shares, but the share price has come down $50. So that's probably a very good thing, because when the stock price comes down like that, it might attract additional buyers, which will then drive the price up.
I think Google just did some sort of split too, not that long ago, right?
Oh, yeah. Google. The one that was amazing was Apple. You know, about it's not even 20 years, about 15 years ago, Josh, Apple looked like it was going out of business. You could have picked up their stock for like $4 a share. And now it went up to about $1,700. I don't know where it is now. It's probably much higher, but it went up to say $1,800. And then they had a 7-for-1 split. That meant If you had if you had one share at say 1,700, you now own 7 shares at, you know, $202.50 or whatever. So yeah, these stock dividends, I used to love them whenever I get one. Whenever I get a stock dividend in the mail, I love it. It means I have twice as many shares, but the value of each share has been cut proportionally in half, okay? Stock dividend requires a journal entry. You have what's called a small stock dividend and a large stock dividend. And I don't know how much detail we want to go in on this, but in the other textbook, Wiley, they talk about this a little more. Hey, can I, Josh, can I safely walk past that vicious looking animal you have there if I see him on the street? Huh? Good looking dog, huh? All right, here we go.
He said no. He said he'll attack.
He's an attack poodle.
Yeah,
Whatever.
He's my little guard dog.
He's a good dog.
Relax.
A large, let me just give the definition of the small and large. A large stock dividend means more than 25% of the issued stock was handed out, and typically recorded at par value. If it's less than 25, you have a paid-in capital element to it. I don't think we need to worry about that. Now let's understand this slide here. What are we talking about here? Stockholders' equity section. We always start with paid-in capital. That'll be a question on the test. What do we start with on the equity section? Paid-in capital. Common stock, 500,000 before the dividend. After the dividend, 550,000 is out there. Paid-in capital, 25. So we have total paid-in capital here, 575, plus retained earnings of 300, minus the dividend we handed out, equals 225,800. You see what I'm saying, Josh? The equity stays the same, 800,000, 800,000. It's just that people now have twice as many shares as they had before. I wish they would demonstrate that a little better. A stock dividend requires a journal entry. A stock split. What's a stock split? A stock split has the same exact impact as a stock dividend. You're going to open up your mail one day and you're going to see that you got a stock split in the mail. You as the stockholder will have no idea if you just got a stock dividend or a stock split. A stock split is very simple. The price of the stock is cut in half, just like a stock dividend, except there's no journal entry needed. What they do instead is adjust the par value, which is not an accounting transaction. Stock splits, issue additional shares. Again, it reduces par value, increases the outstanding, reduces the market value. Stock split has the same exact impact as a stock dividend. It's the accounting treatment of it that is different. And did you know you can get more than a 1-for-1 stock split? Wow, look at this. We got a 4-for-1 stock split, huh? 4-for-1. So you now own 5 shares of this stock instead of just 1. And again, they're just showing you on the balance sheet how it looks. We start with paid-in capital. We add in retained earnings. And we come down here and we see that the par value has changed. Not too much to go over there, I don't think. Here we go. Here's a couple of multiple choice questions on the test, maybe, huh? Differences between a stock dividend and a stock split. Paid-in capital is going to go up with a stock dividend. So retained earnings will go down, par value. Notice that nothing changes at all with a stock split. Nothing except the par value of the stock. Otherwise, the paid-in capital is going to go up. Retained earnings goes down. The par value is not going to change. Outstanding shares go up, etc. Which of these statements about stock dividends is true. A stock dividend has no effect on total stockholders' equity. It has no effect. Stock dividends and stock splits. Okay, so they're giving us a scenario here where the market price of its 500,000 shares, $2, it tripled from 15 to 45. Okay. Paid in capital remained the same, retained earnings increased. And the president, Miss Joan Elbert, is considering a 10% stock dividend or a 2-for-1 stock split. Show the before and after. So we have a stock situation where we're considering a 10% stock dividend or a stock split. So what do we have here? $2 million in paid in capital, that begins us. Retained earnings, 10,000, total 12, outstanding shares of 500. The par value is $2, okay? Well, I guess they want us to figure this one out ourselves. So why don't we do that? Let's do the easy one first, the stock split. Everything is going to be the same with a stock split, except what? The par value is going to be cut down appropriately. Stock split, nothing changes. The par value goes down. Paid in capital is going to change because we're going to reduce, we're going to debit the retained earnings. And let me start again. Paid in capital is going to stay exactly the same. The stockholders' equity, what's going to change is to record the stock dividend, we're going to debit retained earnings and credit the capital account, common stock. I just got to get this thing done. Put the numbers in. But let me try one more time, see if I can make it clear. Stock split, nothing changes except the par value. After the dividend, we figure out whatever the dividend is. We don't care what the dollars are. If it's say $100,000, you're going to see a reduction in the retained earnings and a credit to common stock, keeping equity the same.
I have a question.
Sure.
Wouldn't the outstanding shares for a stock split double?
Absolutely.
Okay.
Absolutely. You are if it's 100%, yeah. And that's kind of the whole idea of it. Like when Apple got up to say $1,800, the average investor would look at that and say, geez, I can't afford to buy 100 shares at 1,800. That's going to cost me $180,000. They're not thinking, though, you can buy one share, really, right? But it's psychological. You typically think in terms of 100, multiples of 100 when you're buying stock. So Apple said, no one's buying our stock anymore. So they drove, they drove a 9-to-1 stock dividend. That dropped the price to $200. You don't care as a shareholder because now you have 9 times as many shares. And when it went down to 200, hopefully the public started buying it again, and then the price goes up, and everybody makes money, huh? No one ever loses money in the stock market. Just that makes sense, Josh?
Yeah. So then that means for after dividends, nothing changes, right?
Nothing changes on your financial statements at all, except capital. The capital common stock account goes up and retained earnings goes down. They're both equity accounts, so the impact is zero.
Okay.
Yeah.
I understand that.
Yeah, stock dividends. Maybe I'll get one today. Who knows? How do they report this stuff? Retained earnings. What's retained earnings? It's net income the company retains in the business. It's all of the profits since the company began. Net income increases retained earnings. Retained earnings is a part of stockholders' equity, and a debit balance in retained earnings is called a deficit. You don't often use the word deficit in accounting. That is one exception. If you have a debit balance in retained earnings, okay? And here they're just presenting it. You start with the paid in capital and you add the common stock to that. Paid in capital. This is interesting, huh, Josh? The common stock is at par is only $70. So this stock might have had a par value of a penny. And because the paid in capital above it is $2 million. And here they're showing you that we have a deficit. Oh, that's terrible. Terrible. Retained earnings can be restricted by legal reasons, contractual, voluntary. I don't think we need to worry about that slide, really. And again, they're giving you another balance sheet presentation. So, wow, look at this. Remember when we started with this class, our stockholders' equity section was simply Joe Smith Capital, and that was it. Here, we divide and conquer. You start with the paid in capital, and then they're showing you first preferred stock, common stock, paid in capital, preferred and common, retained earnings. Add them all up, you get 4,730,000. And then they have some other comprehensive income and treasury stock, 10,000 shares. We're not going to work on this problem like crazy, but we'll just glance at it. Look at these two slides, because here they're giving you the problem. They're giving you a lot of things to think about here. They've issued 300,000 shares, $3. They were authorized to issue 600. They're giving you a paid in capital number. They got treasury stock. They have cumulative losses. They have all kinds of things here. And they're asking you prepare the stockholders' equity section, which they do on the next slide. So if you go from slide 75 to 76, I think you can learn this stuff a little bit more efficiently. Okay. If you have any questions on it, you can always contact me. And now we get into a couple of metrics, okay? A couple of math problems here. The payout ratio, huh? Dividends declared. You take the dividends that they declare on common stock and divide them by the net income. And that gives a percentage. So for this company here, it's 27% each year. Total dividends paid out in millions. What was the net income? And it comes out to 26.7. This is another botched up slide. The net, they're saying here the net income is 2440. Well, I guess they wanted to say that it was 4240, and this should have been 37. This one is right. This one is wrong. Ooh, that's pretty annoying. But let's think about it. Let's look at the one that's right. You take the dividends you paid out and you divide it by the net income, and that's telling you how much money the company's throwing back to the shareholders. 27%. For every dollar this company makes in profit, they're handing you a quarter. That's pretty darn good, no? So that's what that measurement is all about. We're going to compare the dividends declared to the net income. The return on common stockholders' equity. Let's see. Here the numbers look correct, okay? Here, except they should have reminded you that it was 4240. Give me just 1 second here. Remember 4240, 3760. They're just bringing that over to here. So look at our formula. Return on stockholders' equity. Net income minus preferred shares. Net income minus preferred. You divide that by the average stockholders' equity, and you're going to get the return. This is the return on the investment. And here they're talking about something, they should have showed this at the beginning. The advantages of debt versus equity. If you borrow money, you don't worry about stockholders' equity. you get tax savings with the deductible interest, and the return on equity may be higher. This here we already studied in the prior chapter. Here's a good one. Return on common stockholders' equity, and then we have the return on assets and what they call leverage, debt to assets ratio. And again, if you look at slides 81 and 82, you can work on this problem here, okay? Slide 81, 82. Again, you can contact me, text me if you're trying to do this yourself and you're stuck. Analyzing stockholders' equity, been over that. Here are the journal entries for stock dividends. You debit stock dividends, which really retained earnings, and you credit common stock. That takes us to the end of today's lesson. That was more than enough, wasn't it, John?
Yeah. One question. I assume that companies do not pay dividends to themselves on the accounting sheets for
No.
treasury stock.
No.
So
No.
when you're calculating the total dividend, it's only on common shares outstanding.
Right. It's only on the common shares outstanding. Yeah, they can rebuy the stock and then do what they want with it if they want to give that to their employees, but that's not a dividend.
Got it. I just didn't know if they had to do some sort of accounting for it somewhere.
No, not for that. All right. Any questions, Joshua? Okay. What do you think, Josh? Should we end the meeting?
Yeah, I think it was pretty, it was a lot, but it makes sense.
It's a lot. But you guys
It
can
makes
do-
more sense once I do the homework.
Yep.
It definitely clears up.
And you know where to find me for tutoring if you need some help. So we're here for you.
Perfect. Are you guys gonna be meeting today on campus?
Yes,
Okay.
come on down and join us. Absolutely.
Perfect. Yeah, I've been busy, but this time for sure I'm gonna try to make it.
Yeah,
What time?
5 o'clock.
5.
Have you
And then
Have you met Cornelia?
no.
She will be there. She's back from Germany, so that'd be nice. She'd like to say hello.
Perfect. Yeah, and also maybe we can talk about the timing for the test situation.
Absolutely.
that I had. Perfect.
Absolutely. And I have a student who's also coming to this little meeting at 5 o'clock, and he has the same problem at 2:40.
Okay.
He just totally ran out of time.
Yeah, and the location, it's on. Can you tell me
On
the
the West
location?
Campus.
West Campus.
Yeah, you
Perfect.
just park and then walk up the steps. You'll see us sitting there.
Okay. Perfect. I'll see you guys later on today.
Okay, you take care, guys.
Thank you.
Have a
You
good
too.
one.
Have a good
Bye-bye.
day.
Stay safe.
Bye.
Have a good one, John.